NVIDIA giving the markets a big boost this morning after it eased some concerns about an AI bubble last night. Jensen Huang saying he sees it differently on the analyst call. Not just that, but if you look at the numbers they reported, much stronger than expected earnings per share, revenue that came in more than $2 billion ahead of what the street had been anticipating. Talking about what they see for the current quarter, also much above what the street had anticipated. We'll have much more on that in just a bit, but that stock up by close to 4.9%. You are talking about probably more than $225 billion in market cap being added to NVIDIA this morning.
Okay, now to our newsmaker of the morning. He's here joining us to discuss the markets, the history of economic bubbles, artificial intelligence, so much more. Bridgewater founder Ray Dalio is with us. Good morning to you, sir.
Good morning.
So you've been providing lessons for us for a very long time about economic cycles and where we are and what's going on. The big question in the market right now, because we're looking at NVIDIA this morning, and I think a lot of people are waking up thinking, where's the market headed next, has been this question of an AI bubble. And I'm curious where you ultimately come down. Are you with Jensen Huang, who says he doesn't see it that way, or do you see something else?
There's definitely a bubble in markets. Bubbles, what is a bubble, right?
Okay, what is a bubble?
What is a bubble? A bubble is that there's a lot of creation of wealth from various ways, such as you decide that you're going to have sell $50 billion worth of stock and value it at $1 trillion. Or you have multiples like that, and then you create the wealth that way. And then the question with all this wealth relative to money is who needs the money. So it's a matter of who the buyers and sellers are. For example, if we had a wealth tax,
right,
or if you had a tightening of monetary policy, then there has to be the selling of those assets. So in order to pay those things. So there's a mechanics of who owns it, is it over-owned, and so on. It's not the long-term duration of the earnings. So you think about it, isn't it interesting that we have such a short-term reaction? It's great that what the results are, but this is it's valued as a long-duration asset. So for 25 years, the next 25 years, it's very unknown. We don't know what's going to happen, and bubbles don't happen because of good estimates of what in the future. It happens because of the need for cash. Do you sell that asset? Do you have to sell that asset for cash for some reason?
Well, that's the question, though.
So your book, I thought, did such a good example. I mean, I thought, by the way, your book is fabulous.
Oh, thank you.
But you take the 1929, and then you say, what made it go up and what made it go down? And that dynamic is the way bubbles work, right? And so if you take who has exposures, how much leverage is used, and so on, this is about 80% into a bubble that was 100% would have been 1929 and 2000.
So how much leverage do you think is supporting all of this? Because we were talking to Partsenevelis in the last hour, and she was explaining this idea that Jensen Huang doesn't see a lot of the transactions that he's been doing. We were talking about these circular transactions where he's effectively taking an equity stake in some business, and that business is then committing to buy his chips, if you will.
Yeah.
A form of vendor financing with sort of a equity overlay, maybe, is the way to think about it. Do you look at that and say that's a problem? It's not a problem? Should we think about vendor financing in a different way? That was something that got a lot of the fiber guys in trouble in the late 90s, for example.
Yeah, I think it's an issue, but I don't think it's the main issue. I think the real issue is who owns the stock.
Okay.
Is it in strong hands? Not just one stock.
Right.
Isn't it amazing we're talking about one stock for the stock market bubble, and we're talking about for the economy bubble. So you have such a small percentage of the economy, such a small percentage of the American population in terms of wealth and so on, concentrated, and everybody in it, and in a leveraged way. In various ways, it has leverage.
What are strong hands? Like, how would you define that?
Weak hands would be the public.
So retail investors are weak hands.
Right.
Strong hands are the owners of these companies.
Right. In other words, strong hands is that they primarily invest their own money. You don't have public, right? The weekends is largely, let's say, a leveraged public, and all united about that. Yeah. That's one of the key ingredients of a bubble.
Right.
So it's not just pricing, because we have to find out. You know, your book did such a great job of looking at the wonderful companies in the 1920s, and then it enumerated how electricity came out, right, and General Electric and RCA and so on. And those companies went down 90%, not because of the economy and so on. The bubble burst first because they needed cash. So you have to understand that wealth can't be spent. In order to get money, you have to sell wealth in order to get cash to get the money to buy things. And so when that happens, bubbles burst. So bubble bursting means, let's say, a tightening of monetary policy is classic, but also something like wealth taxes can happen. For example, think about wealth taxes forcing sales of assets that you have to.
And you're right, by the way, there's a proposal for a wealth tax in California right now.
Yeah, so state and national, right? State and national. I'm just trying to describe the mechanics of a bubble.
But you said we're at 80%.
Well, yes, I have a bubble indicator that goes back to 1900, and it just makes has a number of indicators. How much leveraging? Who has the leveraging? Is it what is the amount of money in wealth that relative to the amount of cash that needs to exist, and so on? These indicators, there are a number of them, show that we're on that chart. If I was to show you the chart, it's about 80% of where it was in those two times. That doesn't mean that that's the end of the move, okay? Because bubbles have to be pricked.
Right.
And so you can measure that there's vulnerability, a lot of vulnerability. There's a lot of vulnerability of who's holding what.
Here's my question to you about that, which is if the bubble is at this 80% range on your index or metric, there are folks, we had Paul Tudor Jones come in here a couple weeks ago, and he said, look, I think we're in October of 1999. By the way, the market would still have 40% to go. Back in 1928, Charles Merrill, who founded Merrill Lynch, told everybody, get out of the market because he thought it was a bubble. And he was right and he was wrong insofar as from the beginning of 1928 to September of 1929, stock market went up 90%. And so...
But I think that when you're looking at that, you're looking at it incorrectly, okay? What is a bubble is the definition, right? I want to reiterate, a lot can go up before the bubble bursts. A bubble is an unsustained set of circumstances. It has unsustained amount of buying. Right. It has an unsustained amount of valuation. It has, and then there's something that pricks the bubble.
Is there a way to sustain this, though?
Don't sell just because there's a bubble. Okay? Don't sell just because of bubble. But if you look at the correlations with the next 10 years' returns, when you are in that territory, you get very low returns. By
the way, J.P. Morgan just did a report on this that showed that if you got in at over a 23 PE multiple, typically over a 10-year period, your return is a delta between 2% and minus 2% a year over 10 years.
Yeah.
Which gets to your point.
I just put out today a post on this, and you'll see the charts and if you go on that. So I think that you have to say it's unsustainable. Then you have to go to the timing. What is it that pricks the bubble, right? Mm-hmm. Typically a tightening of monetary policy. We're not going to have that now, right? Mm-hmm. But you could have something. In other words, the need for cash. Right. The need for cash is always that which pricks the bubble. Because when you have wealth, you can't spend wealth. Right. You have to sell wealth in order to get the money to buy the things you need or pay the bills you have. That's the dump. Right. So I think that the picture is pretty clear in that we are in that territory of a bubble. We are in that bubble territory, but we don't have the pricking of the bubble yet. Right.
So what does a Ray Dalio, what does the Dalio family do with its money at a point in this bubble of 80%? And you still think it can go higher, but now it becomes a game of timing, which is always very difficult.
Oh, of course, it's a game of timing. Well, and elements of diversification, you know. I think you start off with what is a well-balanced, diversified portfolio. And we talk about certain things like gold as being part of that. There's a lot of ways to diversify. That's a whole other conversation of what you don't know. But I mean, I think that's that mix. We could talk about gold. We could talk about these other assets. But I think that kind of diversification.
What about cash?
I think that, yes, gold and cash have negatively correlated real returns. Mm-hmm. So when you take, I believe that we have a debt problem. Mm-hmm. Okay, because we have a debt problem, we have a value of money problem. But that's right. If you just said, if I held cash, but cash can also be gold. I mean, I think we have to realize that money is, what is money? There's fiat money, and then there's, gold is the second largest reserve currency. It's money. So when it diversifies the portfolio, that is, I think, an important element. It's negatively correlated. It does very well in such bubbles. So when you think of cash, I think of cash as being a mixture of those two things.
But you don't love the U.S. dollar, is what you're saying, because you think we have
I don't like debt. I think debt assets we have a problem. Right. They're overheld, and we're producing too much. The supply and demand is a problem. And so if I was to take my, what is the tactical view, I would rather be short debt in a sense. Right. Okay. And then that means that what money do we have? I think a big question of our time is what money? Right. What is money? What is a storehold of wealth? That's a big question too. There are these two big questions happening simultaneously. There is the AI question, and then there's the debt question.
We're going to slip in a quick break, and when we come back, we can talk about what is money. We can also talk a little bit about Bitcoin, and I want to talk about debt and private credit and how you think about where the debt and leverage lies in our economy, because there's a lot of it. We're going to come back with Ray Dalio in just a moment. I want to get back to our special guest. Bridgewater founder Ray Dalio is with us. Want to touch on Bitcoin, want to touch on private credit, want to touch on this deal economy that we're living in right now, and where all of this lies in the context of the bubble, or the 80% bubble you think we're living in. But let's go back to the leverage for just one moment, because we were talking about that a lot during this broadcast in the last couple of weeks about private credit and the like. Where is the leverage that we should be worried about, if we should be at all? Do you worry about private credit and how connected that is to the banking system or not?
I think we have a challenge in private markets. If you're looking at the private equity markets, they have a bunch of problems. In other words, can't sell deals, pricing of deals, returns, and so on, can't get cash out of them. And then if also you're looking at venture, venture is having problems. And a lot of private credit is connected to private markets. Right. Okay. And I think that dynamic is a risky dynamic in terms of there. But the government credit is what I'm most worried about. In other words, the devaluation, the supply and demand of that over the next 3 years. I'm deeply concerned about that. So debt, and it's increasing because there needs to be more borrowing. Right. You're seeing the hot companies now borrow money rather than raising
And your
equity.
worry is just about inflation and the value of the dollar, and therefore you hedge it through gold. We haven't talked about Bitcoin. Is that how you think about it, or are you thinking about something else?
Yes, I think debt is money and money is debt. When I mean debt is money, when you're holding a debt instrument, you're getting a promise to get money, and the value of that money makes the value of that debt. And the same is true. You hold money, what you're holding it in is a debt instrument. And so what we have is too much debt, and particularly, let's say, the government debt. Right. But other than the government debt, we're now creating the private credit. And you're also creating vehicles that are leveraging vehicles. In other words, 5 times an ETF that's 5 times the volatility of something else. That's the dynamic that I concern myself with. So that means then what is the money? What is the storehold of wealth? Okay, in terms of that, that type of security.
Would you buy Bitcoin?
So there's a supply demand. I have a small percentage of Bitcoin I've had for forever, like 1% of my portfolio.
But do you think you should have more? We keep watching.
But I think I've said the same thing over and over again about Bitcoin. I think the problem of Bitcoin is it's not going to be a reserve currency for major countries because it can be tracked and it could be conceivably with quantum computing controlled, hacked, and so on and so forth. The advantage of gold is that it's an asset that you can hold, and you're not dependent on somebody to provide it. That's why it's the most popular, not fiat currency. I do think that we think the problem is a debt problem. I mean, particularly a government debt problem. And that's not true just of the U.S. We're paying too much attention to the U.S. If you look at what's happening in the U.K., if you look at what's happening in France, number of countries, they can't issue more debt. They're at a limit because the market won't have that. But they can't raise taxes because people leave when they raise the taxes and it hurts asset prices and so on. And then they can't cut spending. So what do? When you can't borrow and you're running big deficits and you can't do any of those. So you have these political changes that keep taking place. Each of those countries had 4 prime ministers the last 5 years. So I think that as we have these also large wealth gap issues, which means that there are billionaires and then there are these, let's say the top 10%, the minus 60%, the lower 60%. Then there's talk of wealth taxes. There's that issue that starts to enter this. There's not enough money around.
Where do you think the money is? We were actually just having a conversation with the ambassador, with a former ambassador to Saudi Arabia, and MBS is here in the U.S. We've always looked at Saudi as this place that has all of this money, especially as they're trying to diversify their economy, and yet there's now a whole bunch of news stories and the like where people are saying maybe they're going to be challenged too.
Well, they're a new borrower, right? They have projects they want to spend.
Right.
Okay. All these countries are new borrowers. So there's a lot of supply of debt, right? What are we going to think about the debt? Put yourself in those cycles. We have a political cycle. There are these 5 big forces that I keep talking about, right? The 5 big forces are the step money economy force. There's a political left-right wealth gap differences that is very relevant to taxes and what that'll mean for the economy. There's a geopolitical force. Okay, then there's acts of nature, and then there's technology. These are the 5 big forces. But when there's these interactions, so you can't separate the political from the financial that we're talking about, right? So as we go ahead, let's say, for example, I think as we look ahead, it's like it's high risk that the Democrats will take the House. Okay, so now we're going to come into another kind of situation in terms of the political conflict is going to be very different. And that's happening at the same time as there are these imbalances. And so we must agree that there's this dynamic that's going on. Your book was so good in really vividly painting the picture. But if you look at that picture and just think about it as what are the mechanics? What caused the bubble? How did the markets go up? How did they go down? What was it? What financed it? And what caused it to go down? I've looked at 35 cases of those like this. They all happen in the same way. So it's that dynamic. It's a confluence of a certain amount of debt that is existing, and we know where it lies. And then there's the issue of the need to convert wealth into spending.
It's too much wealth and not enough money is basically
That's right.
what happens. So the wealth just disappears and goes to wealth heaven. It never gets transferred into being money.
Yes, and if we look back to the Bible and the Old Testament, and you look at all of this, or you look back to banking, it's a lot of people walking around with claims on money. Okay? When the 2 claims on money become too great relative to the quantity of money, that's wealth relative to money, then you believe, everybody who holds wealth believes that they can sell that money, that wealth, and get money and spend it. Oh yeah? Try it. So it's like it's that dynamic.
But here's the thing that I'm concerned about, which is you talked about trying to diversify your holdings, but in every major moment that the markets have been quote unquote punctured, and the bubble, it's hit everything, almost across the board, and sometimes violently.
Well, again, I would say it depends on what it is. I've done very well. Bridgewater's done very well in 2008 financial crisis and so on. Made a lot of money. Okay, there's always the best asset to hold during those times. But if you really
the best asset to hold is during that time.
It's a combination of bonds and gold.
Bonds and gold. Okay.
Right, because one way or another, real interest rates have to go down. And so, for example, inflation index bonds, the real interest rates goes down. They go up. And the gold happens because they have to monetize.
Right.
So if you look at those correlations and take those spikes, those are the things to have. So, but even if you don't want to market time it, just to have balance in the portfolio, that's the most important thing, I think.
Right. Ray Dalio, we want to thank you for being here. It was a fantastic conversation. Learned a lot.
Thank you.
Thank you.